Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Hi guys, welcome back to Macro Insight. Today is the 1st of December, and let's take a look at the markets. Yeah, so we had a good month, November. November turned out to be the best month in global equities since like the 1980s, which is quite surprising, given the state of the world. Obviously, you had massive outperformance of energy and financials, which were up kind of 20% plus. You had that value rotation triggering a move into small caps, and the Russell was up like 18%. And yeah, it was just a pretty staggering move. And we were coming from a place, obviously, of weakness where nervousness ahead of the election had kind of suppressed the market a little bit. So there was a bit of that being unwound, plus the vaccine. So two positive catalysts that really amounted to what was quite a staggering month. So anyway, so looking more recently, so obviously this rally we've had into new highs, if we kind of have a look at that, there's been a bit of a dip. Over the weekend, we had a bit of a dip down towards 3,600. That got bought back pretty quickly, and now we're up again today. But what's interesting is that despite we're making new highs on the S&P right now, but the momentum is kind of waning a bit. So something to be aware of, right? Obviously, Asia also taking a breather. Asia's been outperforming pretty well with a weaker dollar, and China and other Asian markets kind of taking a bit of a breather over the weekend as well. But like I say, the market is signaling that it wants to rally into year end. Like the fact that the dip over the weekend was so short lived, and we went straight back to the highs. You know, people are clearly there waiting in the wings to buy dips, right? You've got the UK talking about potentially approving this Pfizer vaccine even this week, and potentially rolling out before Christmas, start rolling out the vaccine from sort of early December, sort of 7th of December was a date that I saw. We've also got the lockdown ending tomorrow, so businesses can reopen again, depending on which tier that they are going to be in the UK. And then also because of the pressure that the Tories are putting on Johnson, he's talked about a February sunset for the restrictions. So, you know, if he can manage to get enough, traction on the vaccines, then he's looking to end even the tiering system by kind of early February, which will obviously be great news for the economy. All right. So these are the type of positives that are out there at the moment. So even though the sort of reality is that the vaccines are going to take probably quite a bit of time to roll out to enough of the population, once the vulnerable people have been given the vaccines and these restrictions are potentially lifted, then the market's kind of looking forward to that. And that's why, you know, it will probably, when they do get approved, it will probably trigger a little bit more upside in the market, I suspect. Yeah. But I think we're getting quite close to pricing it in now. If we look at some of, you know, I talked about the seasonality and how people are kind of generally quite optimistic for a year-end rally, as people kind of set up for a bullish positioning for early next year. So we're having a bit of that going on. Sentiment seems to be pretty bullish right now, given the vaccine news, given, you know, how value sectors are still quite cheap in terms of, you know, how they look versus where the upside in them. So people are some sentiment data that's been flying around in the Twitter sphere and stuff is showing that sentiment's a bit extreme bullish right now. Cash level, there's like a fund manager survey that one of the banks does, shows that cash levels are pretty low in terms of where they relatively would be. So when I say cash levels low, that means cash on the sidelines is low because money has been deployed into risk assets or equities in particular. right? So cash levels are low. So all these things are suggesting people are kind of geared up for the rally, are expecting the rally, and kind of the path that everyone wants is higher in markets, right? So usually when it gets to that level of bullishness, I start to get nervous, and I start to look for any signs that maybe that you might want to take the other side of that. And the type of signs that I look for, a technical one is this thing called momentum divergence, right? So if we look at the S&P, something I look out for is when you're making new highs in price, but your momentum indicators are not making new highs. So as I mentioned, the RSI is not managing to make a new high versus where it was when we first tested these levels. We've got another momentum indicator I look at, which is much worse actually than when we first reached those levels. So you're getting quite a bit of bearishness from that momentum divergence, I would say. Like it's like a bit of a pre-signal to a potentially exhaustive point in the market. Okay, if you look at the Nasdaq, actually the data on the Nasdaq is a bit delayed, but same sort of story, right? Nasdaq's kind of up towards the top end of the Bollinger Band. Momentum's not making new highs there. DAX is looking particularly weak, I would say, on the momentum front. That indicator there quite a bit lower, again at new highs in spot price. And actually, if you look at the DAX, this kind of 13,450 level has acted as a cap in price going back all the way to August. So it really has struggled to break that level, despite the positivity on the vaccine front, etc. Right. So, and also, if you look at the German bond market, some of that price action is showing you that the market's expectation for the European economy is a bit weaker, right? And usually the bond market is quite good at calling that, which is not necessarily the same signal the US bond market has been giving, right? So, you know, potentially the German economy facing a bit of headwinds, and the stock market at a place where shorts might start to look interesting. So the type of structures that maybe, you know, I've been using, I've actually put a trade on today where I've done a January put spread on the DAX, and I've sold some call spreads to fund that basically. So I have a limited risk on the upside. That's because I've sold a call spread rather than a call, and I've bought a put spread, which is kind of, you know, 13,200 down to 12,200. So it's like 1,000 point wide put spread to middle of January. You know, who knows if we're going to go all the way down there, but the point is it gives me quite a lot of upside having that put spread. You know, if we were to get a correction in the DAX down towards the bottom Bollingers, you know, that's around 12.5. So that put spread will be nicely in the money, and I'll be able to monetize it and probably make some money out of it, right? And if nothing happens and we just kind of sideways trade around here and we don't break 14,000 by January expiry, then I lose very little because my net premium, I haven't done it zero cost, but I've done it relatively low cost. Yes, because I've sold that call spread to get some premium back. So that way, you know, I don't lose a whole lot of money if we don't go anywhere. But if we go down, I've got some potential money to make, right? So that's how I'm expressing my bearishness on the DAX right now. Obviously, volatility, the flip side of that equity story is what's the VIX up to. If we bring up VIX term structure, you can see VIX spots at around 20, realized 10 days at 13.6, 20 days at 16, and 30 days at about, what, 20? Obviously, that 30-day includes the crazy moves on the vaccines. So since that move has been digested and markets have stabilized, realized vol is more in the 13 to 16 area. And yet the VIX is still at 20. So you could argue there's still a little bit of risk premium in the VIX. If we stay moving this type of realized, where we're moving like 1% a day or less, arguably the VIX can continue to drift into that 18 area maybe by December expiry. But it feels like we're starting to run out of juice a bit on the VIX in terms of how low it can go. So my prediction is probably 18 is a bit of a floor on the VIX for the rest of this year. We could get there, but I suspect we're going to struggle to get below 18. At the moment, the futures are pricing 22 on deck, 24 on Jan. I suspect that will continue to remain pretty steep, and you'll see December maybe get as low as 20, that future, whilst Jan's going to probably hold above 23, I suspect, right? So that curve might continue. If vol continues to go down, that curve continues to steepen, most likely. If, however, we do get a wobble in the market, because, like I said, these bearish divergences that are popping up, and the fact that you've got extreme bullish sentiment, seems like everyone's got their kind of portfolio a bit long now, so the pain trade in the short term might be to the downside. If that happens, then obviously the VIX could pop back into the mid-20s. I would take that as a selling opportunity for VIX. Certainly if it happens anytime in the next couple of weeks, if you get a pop in the VIX up to sort of 25, 26, then you probably sell it into that holiday period, and that would be a nice sort of mean reversion normalization trade to be doing. Yeah, but right now I think de-risking a bit of equities, or at least putting a few hedges on, makes sense, because I think sentiment's gone a bit too far. Yeah, you might get that final little push on the approval of vaccines, but I just don't know if there's that many marginal buyers out there that need to buy the market who haven't already bought it. Yeah, so that's why I kind of feel like this rally might be running out of steam a little bit. So that's the kind of outlook on the VIX. In terms of trading the VIX, I've been short it. In terms of futures, I've also had some puts on the VIX. I've unwound majority of my positions there. So kind of that's been a good run. Obviously, I was setting all that stuff up before elections, and it's done well, and I'm taking most of that off the table now. To pretty much just to give myself some bullets that if we do get a spike in the VIX, then I've got the bandwidth to sell into that, basically. That's kind of the reason to de-risk that a bit. Yeah. Okay, next thing to talk about would be the dollar. So the dollar has remained weak, no major surprise, kind of we expected that to remain weak. It hasn't really accelerated in any meaningful way through, but it has broken that 92 level, and it seems to just be, trading very heavy right now. Now, you could say that, it's stabilizing, the momentum isn't overly bearish, it's kind of holding that level. So maybe, but there's not really a divergence in momentum. So there's no reason for me to believe there's going to be any meaningful bounce in the dollar right now. I still expect that pressure to probably remain on the dollar. Yeah. And there may be a chance of it even accelerating. Yeah. If it takes out this level. I mean, if we look at the flip side of this DXY chart and go to the euro, this 120 level on euro is what's being defended. Now, apparently the ECB is not a massive fan of euro above 120 because it kind of provides a bit of headwind for the exporting economy that is Europe. So they don't really like to see euro go too much above 120, and then they start talking up their dovishness when that happens. So that kind of keeps a bit of a lid on the euro at 120. But technically, if it breaks 120, it's easily got to move up to 122 in short order. So for me, I actually quite like being long euro, or certainly being long calls on euro, because they're not very expensive, right? So if you want to have a quick look, we can see FX calls, maturity, probably March we can look at. So with spot here, the implied vol levels on these calls, on these 122s up to 125s, the implied vol on those things is 6 to 7 vol, right? Which is not an expensive number to be paying for options that will give you leverage to that breakout, right? So there's definitely, some money to be made if we get that break of 120. These sort of upside calls to March in euro have easily got a 2-3 times your money type profile if you want to buy those, I would say. Yeah. So not a bad way to play a potential break down in the dollar and up in euro. Yeah, if that's the way you think it's going to go. And then gold, right? We've been banging on about gold for a couple of weeks now, saying that, it was going to break down, and the kind of targets that I had were actually achieved sort of yesterday. Let me bring it up. So, once we broke that level at 1825 and then the 200-day moving average, it wasn't long before we tested my major support here at 1765-ish. I actually have, like I said, I've had some hedges on gold against some of my longer term positioning. I started monetizing those hedges. So, I had sold calls and I had bought puts that expired at the end of Jan. I covered a lot of my calls, particularly, the ones expiring in Jan. I covered all of those. I also monetized some puts that had gone in the money. I haven't sold all my puts out yet, but I've sold about a third of them. The reason I haven't sold them all out is despite hitting my target level, at which point I did expect a bounce, which is why I bought all my calls back. I don't think the kind of the bearishness in gold, I don't think that's over just yet. I think there is definitely room for the fact, like I said, the vaccine news to create one further push up in the market. If that happens, it's very possible that real yields continue to rise. Market continues to love the idea that growth's coming back in Q1, and that's going to be bearish for gold, right? So gold has, even though 1760 for me was a big support level and we did react off it instantly, if it broke, well then, realistically, it's got another $100 sell-off in it, basically, right? So if that $100 sell-off happens into year end, I don't want to just be naked long gold exposure just yet, right? So I'd much rather just keep some puts. When they become worth a load of money, I'll roll the strikes down to monetize them that way. But I'll just maintain my long-term exposure. And then obviously if gold just rallies straight back to 2000 for whatever reason, then at least I've monetized some of my puts and my risk reversals that I've been trading against it, or my long-term position will then recoup a load of money, right? So I don't feel pressured to take those puts off right now, because I'm not really comfortable being outright long gold in massive size until I feel like the fundamentals are fully priced for a recovery on positive vaccines, rollouts, all that stuff. When the market fully prices that in, which it may do over the coming weeks or even into January, then, and say gold weakness persists and takes us down to like 1650 or something, then I would probably get comfortable in the idea that things are fully priced for perfection, and I'll take my entire hedge off and I'll keep my gold exposure for the long term, basically naked. Yeah, that would probably be how I'll play it. But right now, still very much have some puts in place. Yeah. That is gold. Silver is always a similar story to gold. Had a lovely little move down to 22, which was one of my big support levels. I did pick some tactical silver up. So like I say, because I'm maintaining my put exposure in gold and my protection, and I'm not getting rid of all of it, that also gives me the flexibility to play around in things like silver, right? Which is a much higher beta asset. So when we hit a key level like 22, you see here, I was able to pick that up. And my thought was we could easily bounce back to 24 before we even go down again. I mean, 22 to 24 is nearly a 10% bounce, right? So you have the ability to nibble on things like silver when you've got the put protection in gold anyway, and with a view to then flip that silver position if it makes some quick money. So this is exactly what my plan is, right? So I bought the silver at 22-ish. It's already gone to 23 and a half. I'm probably going to trail my stop at around 23. So if it rolls back over, I'll nick some money. If it gets above 24, 25 area, then I might just get rid of it, basically. Yeah, I'll make the decision when we get there. But I haven't made a firm decision on where my target is yet, but it just felt like 22 was a lovely level to get involved. And it transpired it was a good level to get involved, right? So that's kind of where we are. So that's gold and silver. Obviously, might as well talk about Bitcoin since we've done gold and silver. Bitcoin's been absolutely mental. And it's having 10% daily ranges, right? It's just the most crazy market ever, which is fun, but it's fun to trade. So you had the big correction last week, dramatic correction from 19.5 down to 16.5, 3,000 point correction, right? Not bad, 15% correction in like a couple of days. It couldn't manage to stay there, right? It didn't even manage to stay there for a week. So it bounced off there and it bounced in style and it took out the highs, right? So pretty crazy. It managed to post a monthly close yesterday at new highs. So that's pretty bullish for the longer term picture. Today it's having a little bit of a rollover, but like I say, we seem to be in a world of Bitcoin now where 10% daily ranges are normal. So don't be overly surprised to see these type of crazy intraday swings. That is the regime Bitcoin's in right now, because it's kind of, the whole world is now questioning, is this thing going to 100,000 at some point? Yeah. So therefore fair value for Bitcoin is very difficult to ascertain now. And so the volatility of Bitcoin, it's no surprise, is going to be quite dramatic. Yeah. So how have I been playing this? Obviously, I've been accumulating Bitcoin for a long time. I didn't really let any go, to be honest. I didn't let any go. When that dip came, I actually bought some stuff. I didn't buy any futures, but I bought some tactical options related positions to try and play a recovery back to 20,000 by Christmas. And well, we recovered back to 20,000 within a week, right? So I mean, I've done okay. I've made some short-term money. I haven't banked any of it yet. If we get to 24,000 by Christmas or by year end, which I think is very realistic, right? If you look at the kind of the trend of this thing, it did come back down to the average. This is the Bollinger Band for the dailies, right? It came back to the average, which is a 20-day average. It went straight back to the top of the Bollinger. If this thing kind of chops around and continues its uptrend, we could easily, by the end of December, we could easily be at 24,000, right? So if we get there, then my tactical longs that I've added will do nicely. And my core longs that are for the long term are not going to be touched, basically, right? So I think that's the story on Bitcoin. No reason to change that. Ethereum, kind of similar. It's had we look at the spread between Ethereum and Bitcoin, which I've kind of flagged recently, that seems to have stabilized a bit. So it's very, very low, Bitcoin outperforming. Then Ethereum had a massive catch up, and now we kind of chopping around. So that ratio between Bitcoin and Ethereum is kind of stabilizing. But if we do take out 24,000 or whatever quickly, I suspect this ratio will continue to go up and Ethereum will continue to outperform. Yeah, so, I can see a situation where Bitcoin goes from 20,000 to 25,000, which is a 20-25% rally. Ethereum could go from where it is now, which is like 600-ish, to 850, something like that. So those are the kind of orders of magnitude of moves that are possible in the next sort of few months, I imagine. Okay, that's kind of what I'm looking at in crypto. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.